Which would be hard.
Yeah. Okay, we got 100 and we're jumping. Registrations are jumping up right now. We're about 100.
I could advance it right now if I wanted to.
Tom, how much content you have? You have almost until 11 o'clock, right?
Yeah, it's going to use every bit of it, I think, unfortunately. There's a ton. I'll try and compress it. We've already gotten some questions from Mo, so I'll run by those at the end. And we have time. We can chat some in, but otherwise we'll respond later.
Okay. All right, so we're at 150 folks online, and I'm going to go ahead and get us started. Start on time, and we'll end on time. Good morning, everybody. My name is Matt Mayhood. I'm the president and CEO of the Silicon Valley organization. Thank you for joining us this morning. On behalf of our board of directors and our staff, I want to let you all know that we're here for you. We are busy working behind the scenes, advocating on your behalf, and continuously trying to find new resources to help you stay informed with the very fluid legislation and regulations related to the COVID-19 pandemic. As a reminder, the SVO's COVID-19 resource page is constantly being updated with new information for you and your business, so be sure to check that out at thesvo.com. We're pulling in resources from all over the place, so please check that out. Today, SVO member Petrinovich Pugh Co. will be providing us with an update on the new tax changes and discuss the economic relief measures made available through the CARES Act as a result of COVID-19 pandemic. PP&Co, as they're also known, has been a member of the SVO for 15 years, and we're very thankful for their partnership and support. In fact, one of their former managing partner, Mark Parkinson, is our immediate past chair of our board. Little housekeeping, all of you were muted as you came onto the phone call. We'll keep you that way just for the efficiency of the call. We are recording this, and we will have it posted on our website for the end of by the end of the day. And then we had pre-submitted questions that we've given to Tom. They'll be taken into consideration as Tom does his presentation. But we'd also ask that if you have questions that come up, go ahead and post them into the chat box. Address them to everyone. That way we can all see them, and if there's time, maybe Tom can get to that before we close out at about 11 o'clock. So with that, it's my pleasure to introduce senior partner at Petrinovich Pugh Co, Tom Wagstaff. Tom, thank you for being with us here this morning. We're eager to hear what you have to say and give us an update on all the changes that this pandemic has brought us. So with that, Tom, the floor is yours.
Thank you, Matt, and thank you, Mo. I hope you can hear me. These are challenging times, of course, and I was thinking driving in that those of you who are listening, you might look forward, maybe June or July, and look back on your calendar, and if you really want to know what was going on during this period, and say, I actually tuned into a webcast with an accountant talking about a virus and taxes. That's where my life was in early April, and hopefully it will be a lot better come June and July. As Matt said, this is a very fluid situation. PowerPoint we provided here, prepared, we've already had to make adjustments in the last 2 days. Things are changing rapidly. I should tell you that the purpose of the law, and we're going to be talking about the CARE Act in particular, is speed. This is not your typical tax law. This is not my typical tax presentation where I'm talking about tax rates. Is it 35? Is it 37? Something we can just discuss. This is an emergency. As an emergency, they passed this CARES Act very quickly, and you're going to see as we go through the details, you can tell that it was passed quickly. There are issues that are unopened. SBA has been put under a lot of pressure to define the terms, and yet they're being told to get these loans out quick. So we're going to be giving you our guidance on how to handle that particular dilemma. And by the way, if I had known this was being on camera, I would have used my Flow B, which I just got from my brother, but Not sure how to use it yet, so apologies on that front. So we're talking about the CARE Act. First, as I said, we're in unprecedented ground here. It's rapidly changing landscape, lots of anxiety out there, lots of confusion. We're going to try and provide some clarity, but we're going to be honest about it. These things are changing rapidly. You've got to stay close to, we have a great resource page on our website, and SVO also has a great resource center because things are changing rapidly as the law unfolds. But as I said, I'm going to focus on the CARE Act in particular, and a little bit on the Family First Coronavirus Response Act, which has to do with family leave and sick leave. The first thing, which I call this first bullet point, which I would call the accountant relief portion of the tax legislation, is that the federal and California income tax filing dates have been extended from April 15th to July 15th. The easiest way to try to deal with this is if anything you had that was due, either as a return to be filed or a payment to be made on April 15th, has been extended to July 15th. That goes for your Q1 vouchers for 2020. Those have also been extended to July 15th. Taxpayers can also defer federal and California income tax payments due on April 15th without penalties and interest, regardless of the amount owed. The early submission of the law had an income threshold. There is no income threshold for this July 15th. It doesn't address March, it doesn't address June. It's all about things that are due on April 15th being extended to July 15th. It applies to all taxpayers, individuals, trusts, estates, corporations, non-corporate filers, your self-employment people who pay your taxes with your estimated tax vouchers, now due July 15th. The IRS will temporarily, I should also mention that a question that came in before the presentation was about IRAs. IRAs have also been extended to July 15th as a due date for the payment of your IRA. HSAs, July 15th. The IRS will temporarily accept scanned digital signatures. The IRS will temporarily allow workers to send and receive documents by email. Any tax person that's listening to this presentation that just heard that is laughing to themselves because the IRS level of technology is pretty much Morse code at this point, but they are implying that they're going to be able to receive information by email. Sales tax. The Board of Equalization says that the 2020 Q1 sales tax return, which is typically due at the end of April, is now due on July 31st. That extension is automatic unless you have a tax liability of over $1 million. There's a 12-month interest-free payment plan available if you owe less than $50,000 on sales tax. Property tax, which is due shortly, 3 to 4 days. The payments are still due on April 10th. You cannot extend that deadline, but you may be able to waive penalties and interest by requesting a waiver. The economic income payments, those are those individual stimulus payments. So the entire CARES Act is a $2 trillion act, unprecedented. 328 billion of that, actually 500 billion of that is for the economic income payments. Those are the individual stimulus payments. $2,400 for a married couple filing jointly, $1,200 for single taxpayers is the amount of the credit. There is a phase out. If your income is over $98,000, it starts to phase out up to $150,000 if you're filing married. Those numbers are halved if you're filing single. So how does the credit work? They're going to use your, if you've been filing electronically and also using, provided your account numbers through automatic deposit, they'll have that information and they're going to send it directly. If you haven't filed your 19 return, which is what they're primarily going to use, they're going to use your 18 return. If you haven't filed a 19 or an 18 return, they're going to use your Social Security statement to get the data to send this payment. Everybody's asking, well, how do the mechanics work? It's actually a 2020 credit that is being treated as an advance to get the money to the taxpayers now. So when you do your 2020 tax return, you'll see if you qualify, what amount of the credit you qualified for. You will subtract the credit you took. If you took too much credit, you don't have to pay the difference. And if you didn't get enough credit, you get the rest. If, for instance, if using the 2019 calculation, it looked like you only got $2,000 of the $2,400 credit, and you ultimately file your 2020 return and you did qualify for the full amount, you'll get that extra amount. So that's how the credit works on those initial payments. I read this morning where they're promising that they can get the other payments that weren't sent through using your bank account numbers, that they're going to try and get those out in weeks rather than months. I'm dubious. There is a portal on the IRS website where you can submit your account numbers to get the payment sent more immediately. So you should be taking a look at that. So first, the Families First Coronavirus Response Act. My understanding is that some of these things were already covered in an earlier SVO presentation, so I'm going to abbreviate it a little bit, but this is frankly the sick leave and the family leave part of recent legislation. In essence, the point is that sick leave and family leave has been expanded, but they didn't want to put a burden on an already overburdened employer by having them have to pay an additional amount. So the promise made is that the amount that you pay in this new sick and family leave will be basically paid through a reduction in your federal payroll taxes up to the amount paid for full and part-time workers. If the payment to the employees exceeds the payroll taxes, the employer will receive a refund. Qualified sick and family leave wages for which a payroll credit is allowed under the FFCRA cannot be counted if you're also doing the payback check protection loans that we're going to be talking about soon. You can't double up on these credits. There are in essence 3 credits that employers are going to have that essentially run through payroll. The sick leave credit, the family leave credit, and an employee retention credit. Those will all, as I said, be offset against payroll. Now, a couple of days ago, the IRS changed the method by which this credit is accounted for, because before that, it was employers were saying, well, we're not going to have to pay for the credit, but we're not going to get the benefit of it until we file our payroll tax returns, which is quarterly. So to cut that gap, they're going to allow you to reduce your payroll deposits by the amount of the eligible credit that you compute. It'll essentially be an advance of the credit. Somebody asked in one of our questions, are they going to have those 941 forms properly executed to show all this activity? Because now they're going to have to show the credit you earned and also the credit you got. They're promising to have that, but we'll have to wait and see. The Sick Leave Act portion of the credits, you're allowed 2 weeks of sick leave, up to 80 hours. The maximum per employee is $5,110 of paid sick leave to private and public sector employees. I should note that the bill identifies 6 instances where you qualify for the sick leave. The first 3 involved the employer, the employee. Is the employee subject to a quarantine? Has the employee been advised by a health care provider to self-quarantine? Is the employee experiencing symptoms? These are all the characteristics of you being allowed to take the sick leave credit for 2 weeks. The last 3 relate to someone else, typically your child. If you're caring for a son or daughter, if their school has been closed, if they're experiencing other symptoms related to COVID-19, that's where the second level of sick leave is introduced. The payment for sick leave for people that are for the employee is $510 a day with a maximum of $5,110. And the maximum, if it's for those last 3 characteristics of the sick leave, is 2/3 of those amounts. So that's the sick leave provision. The family leave provision, the Act allows for 10 weeks of family leave, capped at a total of $10,000. It's paid, it should be emphasized, family leave is strictly because of the need of your child, not you as the employee. The amount for the family leave is a little less than the sick leave. As I said, you get a total of 12 weeks. The first 2 weeks of family leave is unpaid. The last 10 are paid. The first 2 weeks, however, the plan is directed is that you use the sick leave instead of the family leave. So that's the family and sick leave provision of the Act. The part that I wanted to spend the most time talking about are the loan programs. And I want to preface this by saying, or basically just sympathizing with those small business people out there. Don't get frustrated when I read these bullet points about what the program says it will do, because I'm getting feedback from my clients and others that it's a process that is backed up. They're not getting the kind of response sometimes they want. And of course it's backed up. The Small Business Administration has 3,300 employees right now. They typically do 40 to 50,000 loans. There are 30 million small businesses that potentially could now be eligible for these loan packages that are being sent out. Yes, it's an emergency, but you have to understand the dilemma that they face as well. We called some Small Business Administration people to get some clarification on some of the rules, and they were frankly overwhelmed and asking us for feedback. But here are the guidelines for the disaster loan that was initiated earlier in the year. They're available between January 31st, 2020 and December 31st, 2020. You apply for these loans directly through the SBA at their website. We do recommend, if you've got a great relationship with a bank, use it. This is where you need to get somebody to help you with guidance in terms of the things you need to submit for this loan and to hopefully fast track it. Businesses are also eligible for a one-time grant of $10,000. It's requested at the time of the application for the disaster loan. It's just a one-page thing that says, I want the grant. Interesting to note, you could get the grant for $10,000 even if you don't get the loan. More businesses will qualify under the new rules. Approval requirements have been relaxed and payments can be deferred. The EIDL, which is what we call this disaster loan, obtained after January 31st, may be refinanced with the proceeds of the payback protection loan that we're about to discuss later. The maximum amount of a PPL is increased by the amount of the disaster loan and becomes subject to all the benefits and conditions of the payroll protection loan. The terms of a disaster loan: a $2 million limit, 30-year maximum term. The interest rates were originally higher than this, to 3.75 for small businesses. The funds that can be used to offset the economic losses caused by the COVID pandemic. Approval time is 30 to 45 days. No fees or prepayment penalties, and they're not forgivable. Forgivable becomes the key term here, and distinguishing between a disaster loan and the payback protection loan, which has a forgiveness provision that we're going to discuss. It's a huge part of what they're calling the fallback position to help small businesses potentially survive. That's the disaster loan. The Paycheck Protection Program is the one you've heard the most about, and I want to spend the most time talking about. The Paycheck Protection Loan is used to provide working capital to cover primarily payroll and other operating expenses, and to refinance your disaster loan. Just as a guide to how popular and how manic the situation is, the B of A has already received 85,000 loan applications totaling $22.2 billion. They've been allocated $328 billion. Coming in this morning, I know the House is already preparing a new stimulus package to add more billions perhaps to this. But right now, our guidance to our clients and to people out there is to move quickly with your bank. It's a first come, first serve scenario here. You do need to provide documentation. I'm going to try and help you get your information together so you know what to provide to speed up the process and to help your banker. But you should know that the amount is a lesser of $10 million or 2.5 times your average monthly payroll, plus the sick loan you might have already, the disaster loan you might have already qualified for. The loans are made between January 31st and April 3rd. Work with your payroll provider, determine your average monthly payroll costs. And this is where it gets not complicated, but confusing, because the guidance that the SBA issued subsequent to the original law was slightly different in terms of defining payroll costs. We spent a lot of time analyzing it ourselves, and we're trying to simplify it. When you do the PPP loan application, they're going to ask you for this amount. What I'm telling people now is, based on what we've been hearing in the last couple of days from the Small Business Administration, is that you should, for the average monthly payroll, use your 2019 payroll from your either ADP or whoever else provides it for you. use your full calendar year 2019 payroll, even though the Act says use the average monthly payroll with the going up to the point the loan starts, which would be a more difficult process. So that's the average monthly payroll cost you're going to be using. I'm going to go through some other things you're going to add to that determination, but I want to note that the businesses can apply for both a PPL and a disaster loan. That's another question we've been asked. Can we do both? You can do both, but the important thing is you cannot be what they call duplicative. You can't ask for a loan to relieve your payroll on the disaster loan and also ask for payroll relief on the payroll protection loan. The disaster loan $10,000 advance is excluded from the refi amount. And as I said, if a qualified disaster loan was used for payroll costs, your PPL loan must be used to refi those same costs. What are the terms of the Paycheck Protection Loan? It was originally 4%. It's now 1%. The loan term is 2 years. The payment for the remaining loan amount after forgiveness will be deferred for 6 months. The interest will accrue during that 6 month period. Use the loan payroll proceeds for payroll costs, mortgage interest payments, rent, and utilities. And when you calculate that annual monthly payroll, you're going to limit it to $100,000 per employee. And finally, at least 75% of the proceeds from the PPP must be used for payroll. So to simplify it all in terms of what you would present to your bank, who in turn would go through the Small Business Administration, they're going to ask you for your average monthly payroll. Use your 2019 payroll to compute that. To that, you're going to add your health insurance for a year. You're going to add a small amount of state unemployment insurance taxes. And you're going to subtract all the salaries over $100,000 a year. You're also going to add a small amount of state income taxes, your unemployment insurance. That's going to give you this total average number, and you will multiply that times 2.5, which is essentially for 8 weeks. That will be your loan amount. So the loan amount is determined by your payroll. How you use it is determined by what I said earlier. You can use for payroll, utilities, rent, interest payments on the mortgage. Who is eligible? Businesses with fewer than 500 employees, or those larger that have met applicable standards in their industries as prescribed by the SBA. It includes sole proprietorships, independent contractors, and other self-employed people. They're asking for sole proprietors and independent contractors to submit their submissions on the PPP a little later. I think that one is April 10th. You're already, as we said earlier, able to present your PPP loan proposal to the bank for the other characteristics now. A question we received a number of times is about nonprofits. Only 501(c)(3)s, 501(c)(3)s, and 501(c)(19)s. So C3s are your typical charitable organization and church, and C19 qualify right now for the loan as we read it. A lot of the other 501(c) types of venues, like 501(c)(7)s, are actively trying to get included in the program as well. And I wouldn't be surprised if they do, in fact, do another stimulus that they will be included. But that's one of the questions we've been asked. How about your affiliates for the PPP? It counts employees from all affiliated groups, which are defined as people that you have the power to control. Sole proprietors, independent contractors, and eligible self-employed people are eligible for this loan. They would submit 1099s. They would submit their net income, if they're a Schedule C, to the bank to hopefully qualify for the loan. We mentioned earlier that the loan has to be used for your payroll. It also can be used for your utilities, your mortgage interest, and your rent. The important thing is if you use it for those categories, the loan is potentially forgivable. This is the key element you need to understand. Indebtedness will be forgiven up to the principal amount of the loan for payments made during the 8-week period after the issuance of the loan for payroll, utilities, rent, and mortgage interest. As I said earlier, the forgiveness of the non-payroll costs of the loan is limited to 25%. The feds expect 75% of these funds will be used to maintain company employment levels and payroll costs. I said earlier, more details on loan forgiveness will be released. What I can tell you is that there are measurements for whether or not you comply and qualify for the forgiveness are based on your number of employees, what we call your PPEs, and actually your FTEs, your full-time employees or full-time equivalent employees. And one employee is a full-time equivalent, a part-time employee, you do a fraction. You need to retain the same level of employees throughout this 8-week period. If not, a portion of that loan forgiveness will be reduced. Also, if salaries for the covered employees go down by more than 25%, that could lead to a reduction in the forgiveness. If your employee number went down through the forgiveness period, they're allowing you till June to add employees to get your full-time employee number back up so that you can get the full amount of the loan forgiven. So this is the part that is the absolute backstop element of the law. They're literally loaning you this money based on your payroll costs to get the loan. And if you meet these requirements for how you use the loan, that loan can be completely forgiven. What will you need to provide to the lender to substantiate that you properly use these funds? Payroll records, utility bills, rent bills, mortgage bills, things that prove that the funds were properly used. But I want you to focus right now on the PPP, simply on getting the loan approved and getting it into your bank, which means understanding what I spoke about earlier, which is what is that average payroll cost that they're going to use as the basis for doing the loan. That average payroll cost times 2.5 equals the amount of the loan. That's the payroll protection program. And as I said, the other thing to know about it is it's a first come, first served program. And work with your banks, get the information in. We did ours, and the bank, as expected, asked for follow-up information. They will to you as well, but that doesn't mean you can't accelerate your process. Hopefully your bank handles PPPs, but we're looking for, and we'll put on our website, other banks that might be available if they're not. That's basically it on the PPPs. It is a first come, first serve, which I said earlier, and I just can't emphasize enough. Speed is important here. A lot of people that I'm speaking to have probably already done the process. There might be some frustration. We're already seeing that different banks are interpreting the rules differently. That definition that I gave of payroll costs, some companies, some banks are reverting back to the original IRS definition of what they should be. Work it out with your employer. Have the payroll records available for the lender going into the loan application process. Have your insurance amounts available for them to speed up the process. A question that we received that's applicable to us as accountants and to lawyers is to guarantee payments count as payroll for the purposes of doing this calculation. Frankly, the law didn't address it, and there are a lot of things the law didn't address. A conservative definition is that you shouldn't, because they do have a provision for self-employed people and that they should do their own loan application. I find difficulty with the goal being to have 30 partners in a law firm all have to do their own loans. And my recommendation is to work with your bank, but consider including your guaranteed payments up to $100,000 in your payroll cost submission to the bank. Again, the situation's fluid. People are learning on the go, but the banks are working fast and working with you to make sure these things get out. So be creative, be smart, have your records available to go in. That was the most important part of the entire new laws, is the payback protection loan. But there is an employee retention credit. Remember, I mentioned 2 earlier credits, which is the family leave and the sick leave credit that you could use to offset your federal payroll tax. The CARES Act includes a 1-year credit against your 6.2% employee portion of Social Security taxes if the employer was forced to suspend or close their operations. If They remained open, but their gross receipts went down by over 50%. They also will qualify for a different type of computation for the employee retention credit. The amount of qualified wages for each employee to get the credit may not exceed $10,000 in total. The credit is equal to 50% of wages, so there's a maximum $5,000 credit per employee. The credit is refundable if it exceeds the employer's payroll tax liability. Any wages used to calculate the payroll tax credit for the family leave or the sick leave credits, which were part of the recently passed legislation, cannot be double counted and used for the employee retention credit. The employee retention credit will not be available if you're in a PPP or PPL, as we call it, program. Emphasize the payroll protection loan first. Try to get that. It's a loan that can be forgiven. Then work your way through these credits off your payroll. And remember what I said, it's not supposed to cost the employers dollars out of their pocket. The one thing they have to do is reduce their payroll deposits by the amount of the credit they feel they qualify for. As I said, this is this new update on how the credits are issued. All credits outlined will offset not only the employer's share of Social Security taxes on payroll tax returns, but also your federal income tax withholding. That's an expansion of what the credit can offset, and the full amount of the employer's share of payroll taxes. The employer will receive an immediate benefit equal to the anticipated credits by reducing the amount of the required payroll deposit by the computed credit. So there are other provisions of the law that apply to certain taxpayers that we'll go over. And I guess the best way to summarize them is that in the 2017 Tax Act, there were 4 elements of that act that actually hurt businesses. And all 4 of those have been suspended to help businesses through this crisis. One is the net operating loss provision. The 2017 Tax Act eliminated the ability of taxpayers to carry back an NOL and limited carryforwards to 80% of taxable income. The CARES Act allows 2018, 2019, and 2020 NOLs to be carried back now to 5 years. Alternatively, a taxpayer may carry the NOLs forward to 2019, 2020 without that 80% limitation. So that is a big deal for those who need to get those NOLs and get them to hopefully get prior taxes paid released. What we call QIP, Qualified Improvement Property, businesses that are capital intensive. The 2017 Tax Act had a provision that was meant to be greatly liberalized in terms of how you could depreciate your property, your qualified improvement property. It would make it 15-year property and allow you to do bonus depreciation on that property instead of using prior 39 years depreciation amount. It was a huge benefit. Imagine a difference between a 40-year write-off and what could be a 1-year write-off, because if it was a 15-year property, it would be available for what we call bonus depreciation, and you could write off the entire piece of equipment. And a restaurant could invest $2 million and get a $2 million deduction if the law had been properly written in 2017. They screwed up. They didn't get the life right on the original law, but they used this law as an opportunity to retroactively fix that mistake and make that retroactive for 2018. So taxpayers may be able to file amended returns to claim a refund to get this bonus depreciation. We have a problem with our partnerships who have been hurt by the qualified not being able to use this, and they've also been hurt by this interest expense deduction limitation. This is another element of the Tax Act in 2017 that hurt businesses. It limited business interest expense deductions to 30% of the adjusted taxable income of that enterprise and allowed only any excess to be carried forward in subsequent years. It is essentially an NOL. The CARES Act increased that 30% to 50%. What that will do is it will mean more people will be able to deduct that more interest. But obviously we're in 2020, and the likelihood is businesses will show losses, particularly potentially significant losses. So that ability to deduct more interest is of no use to you. They acknowledge that, so businesses can use their 2019 income to calculate their 2020 interest expense. So if you have a $2 million interest expense in 2020 and don't have the income to allow you to take that 50% deduction, you can use your 2019 income. And so if you have significant income in 2019, that will release that interest expense in 2020, which will generate a net operating loss, which you can carry back based on the new net operating loss rules. Your eyes might be getting crossed at this point, but these are important for businesses. The net operating loss, the interest expense rules, and the depreciation liberalization rules for qualified income property are all huge benefits to businesses, particularly real estate businesses in some cases. As I said, the rules are different for partnerships. We have a dilemma with partnerships because partnerships technically can't amend the tax returns they filed in 2019 as a result of a recent tax act. There's a lot of advocacy going on right now to try to allow those companies to go ahead and be allowed to treat those returns as if they've been extended, so they can, in fact, use that provision without having to abide by these new partnership provisions. So that's the business interest expense deduction. I have some time for questions, but we've already been given a number of questions, and let me just go to them. I feel like, let's see, the first question is the question about non-exempt organizations. This one is, do 501c7s qualify? Remember I said it's 501c3s and 501c19s right now. And we're expecting the law to be amended and or the rules to be changed on any subsequent stimulus bill. But for now, it's our understanding, and it's in the law, that it's only 501c3s and 501c19s. I answered this question already. Are guaranteed payments included in payroll? I think you need to use your own judgment on that. Question based on 2018 and 2019 returns. I don't qualify for the $1,200 stimulus. However, I'm a gig worker. I expect to earn less than $75,000 this year. Can I still qualify? Well, remember what I said. The actual computation of the credit is based on your 2020 return. The credit you're getting right now is in advance. So the answer to that person's question is yes, because in 2020, you'll qualify. The problem is you'll have to wait until you file your 2020 return to get it. Let's see, I had a hard time seeing and believing that a PPL can be forgiven. Understandable, it seems too good to be true. Is there gotcha provisions in the law? I think there are not gotcha provisions, frankly, because I think this is an unusual situation. As I said, this is intended to be a cushion for businesses that are in dire strait, and it's meant to be fast. So I don't think that there are the kind of red tape or fine print types of things that you would normally see. As a matter of fact, we're trying to take advantage of the lack of clarity with our banks to get more as our loan rather than less. Remember, you can do both, the disaster loan and the payroll protection loan, but you can't do them for the same items. This is a good question. If a client already is taking required minimum distributions, can they stop? Yes. The required minimum distributions have been liberalized too. You can forestall making any of your required minimum distributions throughout 2020. Relief for commercial property owner not receiving rent with ongoing expenses, including mortgage. So if it's a commercial property situation, and remember I said the PPL loan is based on payroll. Well, payroll isn't as big an issue for those type of enterprises as the loss of rents, the loss of other types of income. So that would typically be a disaster loan scenario that you would go to and provide evidence of your loss. You could also apply for a payroll protection loans for the amount of your payroll, but generally the disaster loan is the avenue to choose for a commercial situation like that. Let's see, what is the documentation needed? And is only the employer required to provide documentation, or is the employee required to provide documentation? The employer provides the documentation. If you are a sole proprietorship, you're typically both the employer and the employee, so then you would be providing your own documentation, which is 1099s and proof of your self-employment income. One question, I'm interested in learning more about the benefits to individuals related to charitable giving. Not much. All they did, to my knowledge, is add an above the line $350 deduction for charitable donations as opposed to just having it be an itemized deduction. Will all banks be accepting PPP loans? Apparently not. Interesting little sidebar, when this was all passing and Thursday they were getting ready to introduce it, a lot of the major banks, dealing with all of the complexities and lack of consistency, just said, we're not doing this until we get more clarity. We're at too much risk and nobody's giving us a comfort level that they know what they're doing. There was a meeting apparently on Thursday night with the Secretary of Treasury and a lot of these major bank people that we'll probably be reading about someday, or there'll be movies about, because in that meeting, they got some level of more assurance that allowed more of them to come out and issue these PPLs, but some apparently are still reluctant to do so. One question is about unemployment insurance. This is not about unemployment insurance. I'm not an expert on that, but the federal government did add an additional $600 a week until July 31st, and independent contractors and gig workers qualify for that unemployment insurance. I think I've basically run out of key points to mention. If there's other questions, I think we'll be able to process them. I don't have access to them here, so.
Hey Tom,
Go ahead, Matt.
Yeah, there's a bunch of questions on the chat board here, and if you don't mind, I can probably ask them and you can try to answer them.
I'll do my best.
Well, you're doing good so far.
Here's Sarah Lynn in my office is going to hand me some too, I think. Or no.
No, I was just going to tell you, you can grab you can look on the chat.
Oh, go ahead.
Let me grab the chat.
Oh.
Go ahead, Matt, just read them.
Yeah, I'll just read them. This came in. Can you address the computation for forgiveness? For the salary part, it looks like a company just needs not to reduce a specific employee's wages more than 25% rather than the overall employee wages.
Right. You need to prove evidence that you use the proceeds for the categories that we've mentioned, the rent, the payroll, and the rest. You're going to have, on the original application form, we were kind of surprised, but now I think I understand why. They asked for how many full-time employees do you have? I think they're going to use that to do this measurement in 8 weeks as to how many you retain. So if you provide in 8 weeks a lower number, that will be served to potentially reduce the amount of forgiveness. The same thing, they're going to ask for your payroll for that 8-week period. And if they see more than a 25% reduction in that payroll, they're going to also reduce the forgiveness. And as I said, they're going to allow you to go to June to try and fix that payroll employee thing if you find yourself short.
Okay, I'm going to jump through these and hopefully, I think some of these you might have answered. For SBA loans, can they be used to pay contractors? If not directly, how about as an expense?
Yes, they can. They can be used. What's going to happen is a typical SBA loan is you're going to be asked to provide your P&L. You're going to be asked to provide your normal expenses, payroll. There's a form that they have you fill out. It's called an SBA Form 5 that will ask for all those, including subcontractors. Unfortunately, unlike the PPL or PPP as we call it, it's my understanding that they still will ask for the borrower to provide their personal tax information for over 20% owners. So that'll be a burden. But we've noticed in our own personal submission that they are come back and ask for information about who are the 20% owners. So kind of a fluid situation, but the answer to that question is yes.
Can you both use EIDL and PPP simultaneously?
You can, but not for the same item. You can apply for both, and I recommend that you do. If you have, remember the PPL is for specific items, payroll costs, and then these others, and the computation of the PPL loan is based on payroll costs. But if you're a business, it's a commercial enterprise, commercial real estate or something like that, where the issue is not your payroll as much as it is lost rents and things like that, that's where you do the disaster loan and you do the documentation for that. That unfortunately has also been the area of the most frustration out there in terms of getting response because they're so flooded with applications. you cannot use the fact that they're flooded as a reason not to continue to press on, especially since our guidance is right now that the House indicates they want to increase and do a new stimulus. McConnell in the Senate said that he's awaiting the results of this first stimulus package before they go into the new one. So we'll just have to wait and see.
I think you might have answered this already because some of these questions came in early. What about an extension for SEP IRA, solo 401ks, DB contributions, or 401ks?
Right. Well, those are also extended. The 401ks are extended. If you do a solo 401k, it's extended. Now, your typical scenario with those types of people is if they've extended their normal return, they have until the filing date of the return to make those payments. But the key is July 15th is now that filing date instead of the old April 15th date. And the IRAs can be made and delayed now up until July 15th as well.
Okay. There's a question here, how to find a lender if a bank is maxed out. And then somebody responded, said the SBA website has a list of participating lenders. Use the SBA site to find lenders, but most of them require you to be current client as of 2/15/20.
Right.
Any input on that?
Well, I mean, when we met with our people and when we talked to some small business people, small business loan people in the various banks, they just said right away, we're going to prioritize our clients and then our leading depositors, and then we're going to work our way through the rest. A lot of them soon thereafter said those were the only ones, as that question said, that we're going to address right now. But there's a movement on to get other banks to participate. We're just going to have to wait and see on this. As I said, just try. There's nothing to lose from trying to get your information in for these loans. And there's nothing wrong with being somewhat incomplete in your application because they're going to ask for follow-up anyway, although our guidance is, given the information we've told you you need to have, like the payroll for the prior year, you should have that ready to go.
Okay. There's some pretty specific questions in here, and I don't want to get into that much detail. If you had an employee on disability they were on the payroll in 2019, is that person counted as being an employee at the present time?
I don't know the answer to that because they're using payroll records, so I don't know that he would if that person's not actually on the payroll. I doubt it, but I'm not sure.
Okay. Any restrictions on wage retention credit? Can we reduce hours by 50% and still take the wage retention credit on the reduced wages?
Yes. The only problem with the retention credit is if you're in a PPL or doing the sick leave credit in terms of doubling up. But, and the wage retention credit has that limit that makes it less beneficial than the others, but it's still worth exploring that one too.
Okay. Someone owns several companies. Can he apply for a disaster loan for each of those companies?
That's a good question. My understanding is yes, but I remember the payroll protection loan, they allow this affiliated group concept for doing the payroll concept, but my answer to the other is that yes, you can.
Okay. What's the best way to compensate tipped employees?
Well, tipped employees and tips are included in the payroll cost calculation. So if you're trying to get the loan, you want the tip amount to be reportable because they're going to be using your payroll records, and tips are typically reported on payroll records. So that's how that would flow.
Here's a question. Does the 8-week period start April 1st or only after receipt of funds? Many of us are keeping our staff employed while waiting for this money, even though we can't operate our business.
My understanding is the 8 weeks at the commencement of the loan.
Okay. Can you clarify how individual 1099 earners can apply for PPL relief?
That's that second category. Apparently April 10th is the date for them. Original question that I'm glad that you asked that. The law is written so clumsily that it would, at first we thought that a business that paid subcontractors would include the payments to subcontractors in that payroll cost calculation. In the guidance that the Small Business Administration issued last week, they made it clear that you don't count subcontractors because, as they say, subcontractors should do their own PPLs. They should do their own requests. And those are the requests that should go out on the 10th. So they do their own, and they would collect their 1099 information and their net self-employment income information and provide that to the bank. I'm not aware of how they're going to get prioritized or how it's going to work, but that's the way the law has been issued. And I got to keep emphasizing there may be, because everybody's thinking these funds are going to dry up. And there's, why should I even try to do this at this point? Well, first, the contractor one isn't even submissible until the 10th. But the other is that we anticipate, as I said, that there might be an additional stimulus to come that might address those people. It seems unfair that just the people that were quit first are the only ones that get access to the loans. It's about basically saving the economy at this point.
Yeah, here's two questions that are kind of similar. Can bonuses be forgiven in the PPP if all other requirements are met? And can we bonus employees with PP loan and have it forgiven?
Okay, so the answer is yes, but you're jeopardizing your. Remember, bonuses are probably going to throw you over that $100,000 per salary per employee amount, so it's not going to help your loan. And if you use, but if I've been asked this question, if we do that, are we satisfying that 75% of payroll test by doing those types of bonuses? The answer is yes, but I think you're creating potentially a problem because you may, if you're paying the bonuses, be falling below the payroll amount for some of the other people that are covered, so they will fall down to 75% of their payroll, and then some of your forgiveness would have to be reduced. But they're just looking at full-time employees and amounts right now in terms of determining what's forgiven and how much the loan is.
Okay, let's see. Wow, more messages down below here. Sorry if everybody online, if I'm not getting, here's a question. Ask Tom if employer portion of the federal payroll taxes, FICA and FUTA, are in the calculation of gross payroll for PPL.
So remember, this was the point of, one of the points of contention. The original law said you were supposed to subtract those from this payroll computation. But the original presentation of the payroll costs also defined them as fiscal year payroll costs going into 2020, and you were supposed to subtract the 2020 FICA. My recommendation is to simplify this and to not subtract them for the purposes of the loan application. It's built into your gross pay. Try to visualize what they're trying to do. They're trying to provide a fallback for your payroll, that they want you to continue to keep your payroll even if you're not in business. That's your gross payroll, which includes your FIT and your FICA. The employer's share is not built into that, but I wouldn't subtract it. And yet it's my understanding that some of the banks are. If you're like throwing your hands up because this is getting confusing, it's because it is confusing and everybody's interpreting it differently. But as I said, for the application and for the loan, I would just use the gross payroll, not subtract anything, and not add any of the payroll FICA either. I would add, as I said, the SUI, the state unemployment, which is a small amount to your payroll costs. I'm trying to simplify this loan application, and I think the banks are looking to simplify it too, which is when this process started to unfold and they were having to look at people between January and the payrolls between like March last year and this year, it was creating all sorts of record keeping, whereas if they just use a calendar year payroll, it was much easier for them to process the loan.
Okay. Let's see. What if we compensated owners with distributions instead of payroll?
Distributions are not payroll, so they would not qualify as amounts for the loan.
Okay. Somebody asked if you got reimbursed through PPP, is that or EIDL forgiveness, does that then account on your taxes the following?
No, no, it's not taxable income.
Okay.
Most loan forgiveness is taxable income. This loan forgiveness is not taxable income. Good question there.
Oh, good, because I just remembered I read that like 20 minutes ago. Can mileage reimbursement, professional development, per diem type costs be used to calculate payroll? I'm a corporation, the sole employee, so I'm looking for the most liberal way to calculate my income.
They're saying to provide your 1099s as a proof of your income, and I'm not quite understanding the rest of that question, but I think if you're a self-employed person and you're doing the PPL, you're trying to establish your payroll, which if you're self-employed is what you're paying yourself. So you're trying to have a larger number, not a smaller number for that purposes. I haven't yet seen how the banks are actually processing the small sole proprietors yet. I'm sure they're not even sure how to do it. But all I'm recommending for anybody that's doing it is to have all your tax return ready and your 1099s ready, and have an idea of what your expenses are as well in case they base it on your net income. If they base it on your net income and you have a loss, you wouldn't qualify for the loan. So again, it's just going to be interesting to see if they look at gross or net.
Okay. Is health insurance considered part of the 75% needed to be spent on payroll, or is that considered part of the extra?
That's a good question. Payroll is included in the payroll in the computation of 75%. Another question that it came up is if it's 100,000 per employee is the limit on the payroll cost, does that include the health insurance applicable to that employee? And it wasn't addressed in the law, but our interpretation is when they say subtract 100,000, we're just subtracting the salary of 100,000, not any corresponding health insurance expenses.
Okay. Can you use your 2019 K1 as an amount for an owner limited to 100K?
That is another great question.
That's why I'm reading them, Tom, because they look like they're good questions.
I know, because that's when, if in fact they want the owner that gets a K1 to do their own loan application, the answer is yes, that's what you would use. My hope is that they'll interpret it that owner can apply through his ownership interest in a company and have his guaranteed payment included in the company's payroll costs. Gray area.
Okay. Somebody asked, please confirm you only subtract earnings over the 100K.
Right. We're not well, I think what they might be suggesting is, I read in the original law that you're supposed to subtract a certain component of your FICA and federal income taxes, subject to determination by each bank, but our interpretation is no.
Okay.
The only other thing you subtract is your pay to out-of-country workers. You do have to subtract that.
Okay. There's still questions coming in. But
we can handle them. They can send them later. We might be doing more of these, so or they can just go straight to Sarah Lynn in my office, and we'll be happy to answer any more.
Yeah, I think that's what we're going to go do. And Tom, what's the best way to get a hold of you or somebody at PP&Co?
Well, that was one I'm not ready to answer. I'm not giving my cell phone out.
Can you give me your home phone, Tom, please? And the 200 people that are on the call.
Contact us. Our number is on our website, which is 408-287-7911. Our website has a really nice resource center that Sarah Lynn and Ron put together that has all the application forms for the small business loan. It has all the technical stuff that I've just given you in there, updates, recent updates, what the unemployment rules are.
Flip to the next slide. It has your contact info.
And oh God, there's my contact information. The haircut is because of the absence of a Flowbee. But there's our contact.
You're a good-looking man. There's no question about it.
Right. Thank you.
Yeah. Okay. So we're up against it. It's 11 o'clock. Want to thank you and your team there at company, Sarah Lynn and Ron, for putting all this stuff together. Tom, if this was a game show, I think you would have done really well, and you'd be the returning champion, so we'd bring you back for another round. So great job.
Yeah, and I don't have to phone a friend either.
No, you did great. So thank you very much, Tom. Really appreciate it. We have another webinar coming out. Our team at the SVO is cranking out more webinars. We have one this Thursday with City Council member Lund Dieppe, City Council District 4. He's going to give a health update and share what the City of San Jose's efforts to support residents and small business and what the city's doing there. So you can register to participate on that on our website. And keep checking out our website for more COVID-19 updates, resources, events, information. And we'll keep providing that for you and our members and our community. And with that, we're going to post this later today and we'll get you additional questions, Tom. Let's continue to keep sheltering in place, shelter and social distance, and we will get through this together. So stay healthy. Stay safe. Thanks, everybody. Appreciate it. Have a great day.